There are four financial statements that you should remember from your introductory accounting class: the balance sheet, the income statement, the statement of cash flows, and the statement of shareholders' equity. To refresh your memory, let's talk about each one of these in turn. The income statement shows the revenue and expenses for the company for a given period of time. In the book, in Table 3.1, the author has come up with an example called Bartlett Company, and it shows their financial statements for 2012 and 2011. At the top, we have sales revenue, and then below that, we've got the cost of goods sold. Revenue minus cost of goods sold is, of course, gross profits. Below that, we've got all of the indirect expenses that are still part of their operating costs. So we've got our selling expenses, our general and administrative expenses, the lease expense, whether it's for equipment or real estate, it doesn't specify, and the depreciation expense. Remember, depreciation expense is a non-cash item. The gross profit minus all of those operating expenses is going to give the operating profit for the company. Everything below there are non-operating items. For example, interest expense. Interest expense is definitely tied to the operations of the business, but it's not an operating item. It's actually a financial expense. So interest expense is the last tax deduction that a company gets to take after all of its operating expenses, but before their tax amount is figured. Operating profits minus interest expense is going to give what the author labels net profit before taxes, or what I would call earnings before taxes. After that, we've got the line showing the tax expense, $94,000 for 2012, and then what the author is labeling net profit after taxes. The label that I would put on net profit after taxes is actually net income. The author likes to point out that there is preferred stock that needs to be considered in financial decisions. And while this is true, it's usually not as prominent as he likes to display in the text. So below the net profit after taxes, or net income, he's got a line for the preferred stock dividends, the payout that goes to the preferred equity holders. And then below that, earnings available for common shareholders. When we're discussing wealth being created in the company, we're talking about the wealth that's trapped within the company that's available to all of the equity holders. But earnings available for common shareholders is what is going to directly affect the stock price. So earnings available for common shareholders is going to be the bottom line that we're going to use if we're talking about the value of common stock. And the net profit after taxes, or net income, is what we're going to be determining when we're talking about the profitability of the company overall. The balance sheet, to refresh your memory, is a snapshot of what the company owns and what the company owes as of a particular moment. In this case, the end of 2012 and the end of 2011. It's broken into two basic sections, the asset section and the section which covers liabilities and shareholders' equity. In other words, the assets have all been financed through one type of capital or another, either equity capital or debt capital. Debt capital is going to be summarized in the liabilities section. For example, accounts payable, notes payable, and accruals are all in the top category, so these are all current liabilities. The expectation is that the company is going to convert each of these into cash by the end of the year. Long-term debt is not a current liability, but it is still a liability, and so that figures into the total liabilities, which are shown as being $1,643,000. Below the liabilities section, we've got the area for the equity. We have preferred stock and common stock, the amount that was paid in by investors directly to the company for the par value of those types of shares, and a section for the paid-in capital, which was also money that was directly received by the company in exchange for shares of ownership. Below that is a line labeled retained earnings. Retained earnings is the profit which is accumulated and been withheld by the company for reinvestment. When a company is growing, they're going to need some sort of an infusion of cash, and they can either get this directly from investors, they can get it from borrowing money, or they can get it from the profits which the company has generated. By using the retained earnings as a part of the investment that equity holders are making in the firm, they're able to grow the company without burdening it with unnecessary debt or diluting the voting power of the existing shareholders. The bottom line on the balance sheet is going to show the total liabilities and stockholders' equity, and you'll notice the $3,597,000 matches the dollar figure for total assets. The statement of cash flows explains how the balance sheet accounts and the income statement accounts affected the company's cash flows during a period of time. For example, we've got three sections in the statement of cash flows: the cash flow from operating activities, the cash flow from investing activities, and the cash flow from financing activities. Below that is an area where the change in cash is reconciled to what should change on the balance sheet. The operating activities are going to include all of the cash items which were related to the operations of the company. So for example, the net profit after taxes, or net income that the company has generated, is the top line on this indirect version of the statement of cash flows. And then immediately we adjust it for any non-cash items and then any investments in working capital for the company. So depreciation is a non-cash item. We're going to add back depreciation. We're going to look at the change in accounts receivable and inventories. We're going to look at the changes in accounts payable and accruals, or deferred expenses, that would all be bound up in the operating activities of the company. Cash flow for investment activities is the summary of the amount of money that was spent in order to invest in assets which are used in the operations of the company. So in this case, the increase in gross fixed assets is shown as a use of cash, a use of $347,000 in this case. Financing activities are how we pay for the investments which support the operating activities of the company. In this case, the financing activities include the change in notes payable, the change in long-term debts, and any changes in equity or dividends that have been paid out.